Wednesday, the 9th of December. I am Bosun Amafai. This is Frontier Opening Bell. Thanks for joining me this morning. My panelist, Orelu Adetunde, who is a macroeconomic analyst at Greenwich Merchant Bank, and Onyeka Ejoma, in charge of industrial goods analysis at Vertiva Capital Management. Thank you, gentlemen, from two great houses. We appreciate your time. I'll run through quickly the equities market. The Nigerian market softened about 0.1%. Ivorian market was stronger, nearly 1%. Egyptian stock market, 0.2%. Kenya softened about 0.12%, and South Africa about 0.75%. The rand also softened to about 15.01 on Tuesday. So we'll take it all the way to East Africa, where Kenya managed to sign a deal with the UK yesterday in the final hours of the Brexit of the UK from the European Union. That's one big story from the Kenyatta's administration. Inflation from Seychelles Islands, inflation 2.25%. Tanzania inflation slows down to 3.0%. Food inflation much lower from 3.4% to just around 2%. Good agriculture production, all output from this East African country. And for the first time, Ethiopia is opening up space for the citizens to open what we call foreign currency accounts. In other words, a domiciliary account is now possible if you're an Ethiopian. Of course, we've crossed that line many years ago in Nigeria. But Ethiopia is now saying they can do that. All of this ahead of the privatization program of the country's main telecommunication carrier, Ethiotel. Coming back to Nigeria, the news around the petrol prices cut back by 5 naira yesterday caught everyone by surprise, but Labour seems to have gotten its way. The Minister of Labour and Productivity says this is not throwing the regulation out of the window, but there will be another meeting on January 25th, 2021 to look at the situation all over again. World cocoa production, 4.697 million metric tons in the 2019-2020 period. We're still getting earnings forecasts from some of the listed companies. FCMB giving its Q1 2021 net profit 3.5 billion naira. And goodbye to Ibrahim, the managing director for NDIC, 10 years in the saddle. And that's statutorily, by the way. And Executive Director Operations Prince Akase Eredoa, who left Nigerian Stock Exchange many years ago and went to NDIC, also completed his tenure at the Deposit Insurance Corporation. Let me ask Orelua Odetunde very quickly, the macroeconomics very quickly behind this petrol price. And what do you think? Is it politics, is it policies, or is it economics? How do we deal with this issue moving forward?
Yeah, well, I'm more or less alluding to economics. We're seeing that consumers already have a lot to contend with food being, relatively being really high. We're also having cost of fuel also heightened, and both of these pressures, both of these baskets have their own influence on inflation generally, and consumer purchasing power is significantly declined, especially in 2020. So it was a move, yes, to more or less reduce the burden being borne by consumers, because we have seen core inflation more or less has trended upwards, especially during Q2 when we saw a sort of reopening of the economy and people started to go out more and transportation expense started to increase. And also for, it had its own effect on food inflation. So we did see that effect. But coming now to telling us that there's going to be a 5 naira cut. Yes, we haven't seen an official circular on this. It's just been mentioned. So we need to see that follow on through that this 5 naira cut is still going to happen, because I think there's still some sort of a disparity among the oil marketers who are saying that they have not still seen anything officially about the cuts, and and they are not even willing to make any cuts because of oil prices and the current exchange rate challenges we're having in the country. So if we're looking at if a 5 naira cut, and also it's sort of, I think it's something going to be temporary. Like you said, there's going to be a review January next year. It also just might not send a very good signal to investors looking into the oil markets, especially the ones who have not utilized their licenses. I think we mentioned sometime that some investors are still, a lot of these investors with these licenses are still sitting on the sidelines looking at the regulation of the sector. So, we still need to see, positives for them. They still need to see positives in the oil and gas sector for them to still utilize some of their licenses. Eventually, would see more production of crude. Crude oil will more or less be balanced. There will be a deregulation. It's expected to bode well. It's expected to bode well for investments, but we're still kind of struggling with it. I mean, we might still be expecting to see some sparks of this reduction coming from every now and then. It might still happen, but I mean, it was a step. The regulation was a step to free up resources in the Nigerian economy.
Okay, so for industrial goods producers, Onyeka, do you think there's anything in here? Because it looks like we've not fully been able to resolve the petrol subsidy as well as electricity tariffs this year, and it looks like we just push it down out to the new year. The Minister of Labour, Chris Ngige, says there'll be another meeting on January 25, 2021 to look at it together. So it looks like we just keep rolling this forward and we're not so firm as to where we want to go.
Yes, I definitely agree with you. But in the case of industrial goods producers, I don't expect much of an impact. The issue is that many of the cement producers have learned not to depend on the national grid for their electricity. Pretty much Dangote Cement currently has, and I might be wrong, but they produce somewhere around 103 megawatts per day, which is very significant. Boa Cement on its own produces currently between 30 and 40 megawatts per day, and they are looking to add another 80 megawatts per day in the next 3, 4, 5 years. So these guys, the main issue, for them with crude prices is how it will affect gas prices and gas to power policy regulation from the federal government. At the moment, with crude prices going up and with the deregulation, and with the FX currency depreciation, saga still going on, it only bodes negatively for their costs, because gas prices are indexed in USD, and when the exchange rate goes up, it affects the amount they spend on gas prices. And then also when the this thing goes up, when the crude prices go up, gas prices also go up. So in effect, it negatively impacts their costs, on the industrial goods, income lines.
I'm just thinking, Orelua and Onyeka, that if we have all the big industrials like Dangote Cement, Boa Cement, Lafarge use electricity from the national grid, can we just calculate how much revenue in electricity that will generate to the government?
You have
humongous.
Yeah, but you have to balance that out with a lot of other unexpected things, because one, the electricity in itself is not consistent, right? Even in industrial estates, you don't have. I haven't seen many industrial estates where they have 24-hour electricity. Now, looking at a cement plant, for example, where the cost of restarting the kiln in itself. Kilns are these very massive pipes that run, for kilometers on end, where they sort of, burn, they heat up the limestone mixture at an incredible amount of energy generation, between 3,000 to 5,000 gigajoules. Very, very significant. And once this thing shuts down it will take weeks for it to get back up to optimal rolling capacity once again. And so in terms of the lost revenue for the private sector, which will impact taxes that go to the government, the lost revenue which will impact employment numbers and income levels for their employees, shareholder value, it has a much bigger negative impacts, to the economy. So it is much better for them to just produce their own electricity. But at the same time, a most ideal situation would be for the government to be able to generate enough electricity to supply to these companies. Because to be honest, when you think about it, it's a whole lot for these guys to produce their own electricity. Imagine a cement maker, having to delve into electricity production. This is a whole new industry on its own. It requires a whole different set of staff, a whole different set of equipment, CapEx, a whole maintenance cost, where you can simply just pay the going electrification rates with the power authorities. There are just different sides to it, and I understand what you mean, but I also think that right now, in the situation that we are, it's best that they generate their own electricity.
For those who are in the microeconomic side, maybe it's time to start a conversation around, perhaps we should just break down the whole electricity thing into industrial and domestic. And perhaps if we break it down, we might just be able to find policies and investments that will fit either of these two, then, or the two, as it were, then we could just move on from there. So that if we want to have a separate administration, whatever it is, for industrial electricity, then we just know what that takes. Then for domestic consumers and for the rest of us, we just know what it takes, so that we don't just get connected to the same system, as it were, and they can just move on. Maybe private sector investors from around the world would just come in and say, look, we can produce electricity for Dangote, Boa, Nestle, Lafarge in Nigeria, and we just want to take that because we are heavy industrial power companies. We will find what solutions fit into that. The investment comes and they can just resolve it in a year or two. Then the rest of us who are downstream, in terms of households, hospitals, schools, whatever, then we can just take our destiny in our own hands, and perhaps we just resolve it that way. I'm just thinking aloud here, don't just thinking maybe,
right.
Because we just don't get anything right.
Right, I think you're correct, but I also think we're seeing like some estates are already moving into that line of also producing their own grids by themselves, or supplying power by themselves, and rather than being dependent on the general power sector, which seems to not be working. So we are seeing a lot of that, but I think one thing we still need to understand, as Onika mentioned, this power sector is still not as reflective. Aside from the fact that it's still not cost reflective, we still need to look inwardly. Accountability is still at a far reach for the sector. So until we see some sort of modification and some changes to some policies in the electricity sector, there's not much that can be done. But I mean, we're seeing more interest. I think we're seeing more interest from some of these corporate bankers looking to fund some of all this electricity for some of these estates, and they might be using the cash flows, as some way, securitization of some of these assets or things like that.
I like that.
So yes, I mean, it might take a while, but we're eventually getting there. But like we said, we're still not an enabling environment, but it's a step.
All right, thank you. Let's talk about Southern Africa, and I'm sure you folks got the news about South Africa's third quarter GDP, a massive 66.1% yesterday in third quarter, and they're going to start using the new measures for calculating GDP from next year. So, is that good news? Is this something we're looking at here? I'm sure this is a highly industrialized economy, by the way. Are you guys green with envy, Onyeka?
I definitely won't say I agree with envy. South Africa is also coming from a very weak GDP base. Since 2017, they've been having economic growth challenges, separate from the pandemic-driven moderation in growth, contraction in 2020, and so we're basically seeing them sort of return more to. We're basically seeing their growth sort of start to normalize. This 66.1% growth is and it's actually an annualized growth anyways. It's basically just, growth sort of normalizing back to the, previous index position. We're seeing them focus a lot more on infrastructure spend. I recall that we can use the cement sector as a microcosm of the infrastructure space. We know that the cement sector has been challenged in the space for a very long time. I was one of the proponents of Lafarge dumping the South African investments, when they still had it, because it was such a big trouble to them. And even Dangote Cement has been stuck with their SACCO investment for quite some time now. But now we are starting to see that investment pay off. Home improvements, building and construction activities in the second and third quarter, even in the second quarter, actually started to improve. I've started to see producers become more courageous, to take pricing higher in the space. Before, pricing had been dropping consistently for the past 2 to 3 years, just because of the demand challenges in that space. And I think that, we're starting to see a return to normal in South Africa, which is positive for South Africa and even more positive for the entire sub-Saharan African economy.
Okay, thank you. Let me just quickly weigh in on the North African space. If you look at the new MSI 20 that the Casablanca Stock Exchange in Morocco created yesterday, December the 8th, Tunisia's Carthage Cement gets 6 offers to buy majority stake. We're just talking about cement makers in Nigeria, and block trading around 500,000 shares of Pyramisa Hotels sold for 10.3 million. Of course, the hotel and tourism industry in North Africa has been under very serious pressure. So in terms of our wrapping it up from you, Orelua, in terms of tourism and hotel accommodation, whatever in Nigeria, we don't have so much of this virus footprint here. So, but it doesn't look like this industry is moving up as anyone will expect.
I mean, it would have been best to go, because I think immediately after, COVID started tempering down some more or less, I think that was, NBI came about to do its IPO recently, and, they are even now demanding so much more from the market than we initially thought. And I think when COVID-19 started, I think it was one of the most affected industries, because, they need travelers more or less to book their places and make their monies and things like that. So it was supposed to be, tourism was supposed to be one place that was supposed to pick up, especially in economies that wasn't, COVID-19 wasn't really affecting much. But, that's different, because the case in Nigeria is because we haven't really touched on that sector. And I think a lot has to do with innovation, more or less, in that sector. I think we're not seeing that level of innovation, because I think some place in Madrid or Spain, something that they have is they don't really take tourists to these exotic restaurants or exotic centers and look at really fancy things. They take them to the streets and just make them look at how things are being done, or maybe meat is being butchered or something, and they just take them to it's very, very, I'll call it more street vendorism or something like that. So you see all those kind of things, and it might not look like that in some of those advanced economies, because they have a lot more tech. They are more tech advanced, and they don't do some of all these things that we do in the African economies. But if you take them to places like that, or you'd find other ways to be innovative in the sector. I think
yes,
it would help. You said?
Yeah. I know, I agree with you, because again, if we had a developed tourism, for example, Kenya is losing massively because of the COVID-19. South Africa is losing so much in tourism because of COVID-19. Morocco, Tunisia is losing, and here we are sitting down pretty with very low record COVID-19, and we can't take just so high.
Yes.
Out of this particular sector. Onyeka, it's so amazing that right now we should just be making so much FX inflows, because at least we'll be making some money, because where you're going, just set the COVID protocols for everybody, and here we were.
Well, the problem, this is what happens when you don't have a very developed tourism industry anyways. So pre-COVID, our tourism industry wasn't the greatest, and you can understand why a lot of foreigners, will not want to come into Nigeria for this. There's a lot of insecurity issues going on across the country. Well, Lagos is a pretty good tourist hotspot. We know that the trend amongst travelers and tourists is to go visit more natural sites, more historical sites and all. And Lagos is not where we have most of these things. You have them in the north central, in the northeast, in the northwest.
Yeah.
We have some UNESCO heritage sites, spread across the north central and the northeast. Not many travelers that will be able to go there. There are lots of terrorism and security warnings, from a lot of global security agencies across that. And we've seen that tourism agencies have been sort of targeting younger domestic travelers, rather than traveling to Europe and traveling, across Africa. We've seen a lot of younger travelers travel across Nigeria. I earlier on in the year, I had planned some trips across Nigeria myself, but it has been disrupted by COVID. And so with all of this, even though we've had like very weak, numbers, at the end of the day, it is still domestic citizens that were going to come in anyways, and not a lot of external tourists. And then when you not have the case of reduction in moderation in aggregate income levels, people have lost their jobs. This affects demands for things like tourism. We always seem to sort of gloss over the fact that Nigeria is economically hard for a lot of its citizens. A lot of people still spend, according to the NBS, we still spend up to around 60% of our income on food, before you get to the tourism part of the equation. For a lot of people, their incomes are already sort of cancelled out. And then you now have the inflationary aspect of everything, which has raised prices across the country, even when aggregate income levels have dropped. So it's a no-brainer that the tourism industry will continue to, the tourism and hospitality industry will continue to suffer until things start to stabilize a bit more. The hope is that by the time the COVID-19 vaccines start to spread around, we should start seeing an improvement in global commodity prices, agriculture prices, and all that sort of supports our income levels in Nigeria and help us, move past this.
Okay. Let's hang it there for this morning. Thank you very much to both of you, Orelua Odetunde from Greenwich Merchant Bank and Onyeka Ijoma from Vertiva Capital. Thank you so much to both of you. Have a great day and see you again tomorrow Thursday. Bye for now.